Imagine this. It's 2025, and the world is on the brink of another major economic crisis. Stock markets are tumbling, unemployment is rising, and people are panicking. But wait, haven't we been here before? In fact, economic crises seem to happen like clockwork every few years. Is there a pattern here? Is someone pulling the strings behind the scenes? In this video, we're going to explore the role of the Federal Reserve in managing and perhaps even creating these economic ups and downs. Specifically, we'll look at how their actions during the COVID-19 pandemic set the stage for what's to come in 2025. The Federal Reserve, or the Fed, is the central bank of the United States. Established in 1913, its primary goals are to promote maximum employment, stable prices, and moderate long-term interest rates. To achieve these, the Fed uses several tools, the most important being the federal funds rate and the money supply. The federal funds rate is the interest rate at which banks lend to each other overnight, and it influences other interest rates throughout the economy. By raising or lowering this rate, the Fed can make borrowing more or less expensive, thereby controlling economic activity. Additionally, the Fed can increase or decrease the money supply through operations like buying or selling government bonds, which affects how much money is circulating in the economy. Let's take a closer look at how the Fed responded to the COVID-19 pandemic. In early 2020, as the virus spread globally, economies shut down to prevent its spread. The U.S. stock market crashed, with the S&P 500 falling by 34% in just over a month. Unemployment surged to 14.8% in April 2020, the highest level since the Great Depression. To counteract this, the Fed sprang into action. They lowered the federal funds rate to nearly zero and embarked on an unprecedented program of quantitative easing, buying trillions of dollars worth of bonds to inject liquidity into the financial system. The money supply, as measured by M2, increased from about $15 trillion in early 2020 to over $21 trillion by the end of 2021. This massive stimulus helped stabilize the economy and led to a rapid recovery in asset prices, with the stock market reaching new highs by late 2020. However, there was a downside to this flood of money: inflation. With so much money chasing a limited supply of goods and services, prices began to rise sharply. In 2021, inflation in the U.S. hit 7%, and by mid-2022, it peaked at around 9.1%, the highest in 4 decades. This eroded purchasing power and put pressure on households, especially those on fixed incomes. To combat this, the Fed had to reverse its accommodative policies. Starting in March 2022, they began raising interest rates aggressively, from near zero to over 5% by 2023. They also started reducing their balance sheet, selling off some of the assets they had purchased during the pandemic. These actions were aimed at cooling down the economy and bringing inflation back to their target of 2%. But here's where it gets interesting. Some economists and commentators argue that the Fed's actions create a cycle of boom and bust. By keeping interest rates low and money supply high, they encourage borrowing and spending, which can lead to asset bubbles and irrational exuberance. When they eventually tighten policy to control inflation, these bubbles burst, leading to recessions or crises. Then, to mitigate the downturn, they loosen policy again, starting the cycle anew. This pattern can be seen throughout history, from the dot-com bubble in the early 2000s to the housing bubble that led to the 2008 financial crisis, and now, potentially, to whatever comes next in 2025. Moreover, political factors can influence the Fed's decisions. While the Fed is supposed to be independent, presidents and other politicians often have strong opinions on monetary policy, especially during election years. For example, former President Donald Trump frequently criticized the Fed for not lowering interest rates enough during his term. Some believe that political pressure can lead to suboptimal policy decisions, exacerbating economic volatility. Additionally, Policies like trade wars or fiscal stimulus can interact with monetary policy in complex ways, sometimes leading to unintended consequences. As of now, in 2025, let's look at where we stand. Inflation has been brought down to around 2.5%, close to the Fed's target. Unemployment is at 4.2%, which is considered full employment. The stock market is at all-time highs, and economic growth is steady. However, there are warning signs. The national debt has ballooned to over $36 trillion, and interest payments are becoming a significant burden. Geopolitical tensions are high, with ongoing trade disputes and potential for conflict. These factors could trigger a downturn if not managed carefully. So, what does this mean for 2025? According to some analysts, we might be on the cusp of another crisis. If, for instance, a major geopolitical event occurs, or if there's a sudden loss of confidence in the markets, we could see a sharp correction. In such a scenario, the Fed would likely respond by cutting interest rates and possibly resuming quantitative easing to support the economy. This could lead to another period of growth, but it might also sow the seeds for future inflation or asset bubbles. The key is to watch for signals like rising unemployment or falling consumer confidence, which could prompt the Fed to act. Moreover, social media and financial forums are abuzz with predictions of high unemployment, inflation, and even social unrest by the end of 2025. While these are just forecasts, they highlight the uncertainty and concern surrounding the economic outlook. In conclusion, while it's impossible to predict the future with certainty, understanding how the Federal Reserve operates and the cycles it influences can help us anticipate potential economic shifts. As we move through 2025, staying informed about economic indicators and Fed policy decisions will be crucial. Whether you're an investor, a business owner, or just someone trying to make sense of the economy, knowledge is your best tool. So keep learning, stay vigilant, and be prepared for whatever comes next.